course, is around Growthpoint, and they've delivered a 7.5% growth in distribution and took assets over the 100 billion rand mark. Growthpoint CEO Norbert Sasse is here for their full year results. Norbert, it's always lovely to have you, and even better when you're in studio. Let's just firstly talk about the prevailing environment and the conditions through which you were able to produce these kind of numbers, and maybe also give us a comparison between the South African and the Australian experience.
So I think it's fair to say the South African market is particularly tough at the moment. Low economic growth. We're sitting with an electricity crisis. We've got commodity crisis. We've got quite a few crises. But notwithstanding that, I think the business model is pretty robust and pretty sound. Vacancies are under pressure and rentals are under pressure. But we still managed to deliver the result. It's fair to say that Australia is probably also suffering. Also a commodity-based economy. We are seeing a bit of weakness there in the office market as well, less so in the industrial office market in Brisbane in particular. That's one of on the East Coast, one of the cities that is impacted the most, I think, with the commodity crisis. Quite a lot of differences though between Australia and South Africa. South Africa interest rates are rising. In Australia, interest rates are flat. Probably there's even still a chance of interest rates being cut further in Australia. Great opportunities for positive leverage or positive gearing, i.e. buying properties at higher yields than what your cost of debt is. You could buy good stuff at 6.5%, funded at 3.5%. In SA, you got the opposite. The good stuff is trading at 7, 7.5. Your cost of 5-year money here is 9.5. So many disparities and many differences, but at the same time also quite a few similarities. The currencies, both the Aussie dollar and the rand, obviously under a tremendous amount of pressure, being very commodity based.
Norbert, your portfolio is probably worth what, 80, 90 billion rand if you include...
Just over 100 now if you include Australia. Yeah.
Goodness me, that's a big chunk of change. You're an Aussie 40 company. You raised some money this last few months, and you've invested too. Do you have the firepower, possibly given your size in South Africa, to perhaps do more investments other than say Australia? And is that on your agenda at the moment?
Yeah, I think I would guess, we've got a very conservatively geared balance sheet. The South African balance sheet is 32% loan to value, so we've got about 25 billion of debt against almost 80 billion of assets in South Africa. Australia is at about 37% gearing. Combine the two, we sit with 33% on a consolidated basis. Very conservative. Interest cover is like 3.4 times, and the bulk of our interest rate exposure is hedged. So I do believe we've got the firepower and the capacity to leverage a bit off the balance sheet and gear up. If we weren't looking elsewhere, we'd probably be the only company in the top 40 that isn't looking, or not even in the top 40, in the top 100 that is not looking elsewhere. It's, I guess one has to, especially in our market where we're seeing what I call negative gearing in the South African market, where we're seeing vacancies rising and rentals under pressure. So all the property fundamentals are sort of against us a little bit in SA. In Europe, US, Australia, and some of the developed markets, you're seeing great opportunities for positive leverage, admittedly driven by ridiculously cheap debt, but the opportunity is still there nonetheless.
If we just stay with the global market play and we take a look at what's happening with China, and also, the timing of rate hikes in the US, just give us a sense of which of these movements are you keeping an eye on most, and which is likely to have a long-term impact on the business, depending on which way the dial shifts.
I think the single biggest factor that can have an impact on us, and not so much in the day-to-day operations of our business, but in the pricing of our share, I guess, and is the US rate hike, or the timing of the US rate hike, and how US rates move and the impact of that on the South African bond market. So we saw in May 2013 a lot of talk about tapering in the US, and the SA 10-year bond went from 6% yield to 8% yield in the space of a couple of weeks. That is not good for listed property, because we trade pretty much as a yield play, and as the yields rise, our share price comes under pressure. So to the extent that there is talk of perhaps delayed interest rate rises in the US, and there was talk that it was going to be September. I haven't really been able to catch up on all of today's news. But if there is talk of a further delay in the timing of the increase of interest rates in the US, I think that will be very good for us.
You also, unlike a bond, provide capital growth over a period of time, which also, I guess, Norbert, is an underpin to your share price too.
Very much so. I think obviously the dual play, if you want, of listed property being a steady growing income stream, you know, backed up by solid leases and good quality properties, and that translating into ultimate capital growth is, I guess, the virtue of the investment case for you know, for listed property.
If we take a look at just the how much of AccuCap and SICOM is captured in these numbers, it's I think around 3 months or so, and so we could potentially be having a very different kind of conversation at the end of the next financial year. What are your expectations in terms of how these acquisitions can begin to positively filter into the balance sheet?
It's absolutely right. It's only in for 3 months of this year, April, May and June. You know, it was a big transformational acquisition in some respects, specifically with regards to our exposure to the retail sector. That was obviously the key driver for us to pursue that deal, was access to great quality retail assets. You know, I guess, you know, when you're buying quality, you know, nothing's ever cheap. So you got to now, you know, sweat these assets. You got to integrate the businesses. That's probably a good 12 months of really hard work, integrating the businesses and you know, getting them on the same platforms, accounting platforms, etc., etc. There's a lot of hard work ahead of us. The one potential negative impact is that if you look at the total debt that AccuCap and SICOM had and the length of their loans and the level of hedging on the interest rates, it didn't quite match up to our own. So, you know, it is going to cost us a little bit to increase the length of their underlying debt facilities and the length of their hedge book, and that'll come at a cost. So we see a bit of a challenge for 1 year, you know, 1 year looking forward. You know, we put out prospects of 5 to 6% growth for next year, perhaps a touch below what you know, some of the analysts might have wanted, but it's a combination of a number of factors. You know, the tough SA economic climate, the impact of AccuCap and SICOM short term, and then Australia, notwithstanding the fact that the Aussie entity is doing particularly well as a standalone entity, as a foreign investor into Australia, they've got some leakage now on the dividend withholding tax. And, you know, the rand, you know, we've got some good gains over the last couple of years with the rand weakening against the Aussie. We're not budgeting in our numbers for significant weakening of the rand against the Aussie anymore. Pretty stable outlook. So that's challenging the growth from the Aussie subsidiary for us in rands. But as a standalone investment on the ASX, it's a phenomenal year.
Well, that's a thorough walkthrough of Growthpoint's numbers by their Chief Executive, Norbert Sasse, who's